All right, all right. Good morning, good morning. It's great to see everybody here first thing in the morning on a Monday morning. And ready to get into our portfolios and see if there's not a way we can make a little bit of money this week. We're going to do something special today. We're going to go through and look at our portfolio, but we're going to also show you how to protect some of your other investments because oftentimes we have these investments, these ROCCs that we've talked about, right? We've got some longer term investments that we hold on to in the ETF world. And those are returning high dividend ETFs. And so we need to talk about how to protect ourselves to the downside. Now, it's kind of controversial whether you even really need to do that with this style of trading. But I'm going to talk about it a little bit in this class, and we're going to talk about that, and we're going to show you how you can protect it if you would like to protect the downside. Now, remember, ROCC is return of cash and capital. And so we're going to talk about that. And I'm going to show you how to use ChatGPT in your trading. All right. So I'm going to show you a little trick, a little strategy that way as well. So we're going to jump in. We're going to have a good day today. It's going to be a lot of fun. Got a lot of nice stuff planned for you. All right. So we're going to come in here. And first thing we want to do is we're just going to pop on over to our our FinViz, and we're going to take a look. This is the market right now. And that's so you can see Microsoft's down, Nvidia's down, Amazon's down, Google's down, Tesla's down, Meta's down, Netflix is down, Costco's down. A lot of the big players are all down. Look at all these communications are all down. Apple's up. Now, Apple's slipped a little bit here. It was up 2. Now it's only up 1. So it's sliding back down. Healthcare, got some nice movers in here. So this is just kind of a heat map, tells you which markets are up and down by their industry. Now, you know me, I like the bubble calculator here. So this is the one that's kind of fun. And I like this one a little bit better. So we're going to come in here, and I don't like that market cap. I like it set to volume and S&P 500. And this is the volume. You can see a very light volume today on most of the markets. AT&T has actually had a good day for some reason. They must have had maybe an earnings or some good news. Tesla, oh, that's Nvidia. Usually Tesla's the big one, but that's Nvidia today, and it's down hard today. So we're seeing all of our favorites, all the technology firms are all flushing today. But that's kind of, we expect that a little bit. I don't like to see it, but markets can't just go straight up. That's not possible. They got to have some pullbacks. They got to have some drawdowns. We call that accumulation distribution, right? And we understand that concept. For those of you who've been here and been part of the class and gone to my university classes, those of you who don't know, I'm a teacher down at the university. And this is the lab for my university class. So you know what accumulation distribution is. If you don't know what accumulation distribution is, well, you can go back and you can look at some of my past videos that talk about it, or you can go search it on the web and search Wyckoff accumulation distribution model. It's very important that you understand that concept. It's probably one of the most important concepts when trading stocks that you can understand. So Wyckoff accumulation distribution model needs to be firmly under your belt. And if you don't know what it is, I actually wrote a little book. Look at this. Of course I did. I wrote a book. All right. And you can go get it on Amazon. It's got a whole section in there on accumulation distribution and all of the different methods and madness, the way we trade here at Trade Mentors and at the university that I teach at. This is actually the manual to the class at the university. So if you take the university class, you get this manual. And of course, you get the digital version. This is the print version. If you go over to Amazon, you can get the print version. Just search Lan H Turner. You have to put the H in there, Lan H Turner. If you don't, because I'm not famous, and so you have to put my H in there, or else they don't find me. Lan H Turner. You'll come up with Lana Turner. Get all kinds of beautiful pictures of beautiful women instead. So you got to put Lan H Turner, and then you get my playbook. Don't get the used one. Don't get the old one. Get the new one. This is the latest and greatest version. I had one student get the old version or a used version, and he got the old version. So don't let somebody send you the old version. Get the new version. Not that much more, a couple bucks. So get the and it's cheap. It's 238 pages, 8.5 by 11. It's a great book. So go get it. It's got accumulation in there. It's all about Wyckoff accumulation distribution model is in there as well. All right. So this is what we're looking at. Let's go look at the news. We always have to look at the economic calendar first thing in the morning and see what's going on. So let's flush that out, bring in the 2 impact, and we're going to look at today, 6:30, 8 o'clock New home sales come out. So that's happening right now. 0.64, 0.69. So the forecast was 6. So that should be positive. Consensus was 0.67 and it hit 0.69. So that's good. New home sales month over month down 3.5. This is actuals up 3.5. So that's good. And then the Fed coming in at 8:30. Hold on, I got to have a drink of hot tea here first thing in the morning. I know out here in it's 8 o'clock for us here in Mountain Time. We got some guys from California, 7 o'clock for them. We got some guys from East Coast, and it's 10 o'clock for you guys. You guys are like ready to take a lunch break already. All right, here we go. Let's come in and take a look at this market. So nothing real fancy on the news front, and not there. Not there. Where was I? Oh, right here. All right. So we got a NVIDIA. I want to go take a look at NVIDIA. This one here is Apple. Moved a little bit. Intel. See, these things are just small. PLTR. Palantir. Oh, Palantir is going to give us an opportunity to get back in. Let's go look at Palantir. Here's Palantir. So we wanted to get into Palantir. I was waiting for Palantir. I was hoping Palantir would hit the red line. And we sold some calls, sold some puts here, made some money on this, but we didn't get our long position. I was looking to get assigned a long 100 shares, but we didn't do that. But we're getting kind of a little ABC pattern up in here, almost a double top. So this thing's coming in, and it's starting to flush again. So that horizontal line is kind of our target price. We'll see if this will come down. Sometimes it's just on its way up. It's just come make a little move, and then it'll move back up higher like that too. So we'll just see if this little pullback today is going to be carry through and drop, or if it's just a profit taking right here as we get up here, and then it'll turn and rally and go up and break all-time new highs, which probably more likely to do. The Palantir is really strong, but you can see we got 3-drive pattern here. We got a nice little, it started way back here, but we got a little reset right here at the red bars. So then we go drive 1, drive 2, drive 3, and then it didn't flush back far enough. It just took right off, and I think that was right around the election time, and then, man, it went to the moon. Got a little bit of profit taking. Now it's taken off again. Now, whether that's going to ABC and take off and go to the moon one more time, or whether it's going to be a little pullback and come back down and test these lows down here and give us a little ABC top formation, nobody knows, right? So we could play that one way or the other if we wanted to actually get in there and get some money out of it. All right. But we're gonna wait on that, and we're just gonna wait and see what happens, because we don't know at this point which direction it's going to go. This is a new reset here. Didn't really reset, but if we call that drive 1, got a really ugly little drive 2 in there, and then it failed. All right. So this is almost like a little reset in here. So again, ABC this way, or it could just be a little, and we don't know. You could bracket it. You could buy a call and a put at the same time and see which direction it goes, because it moves. This market moves. And in fact, if we went down and looked at that, might not be a bad strategy. We could come in here, and you know what else we could do? This is where we could use our strategy that I was going to teach you using ChatGPT. Let's see if I can get out of the way. All right. So we could come in here. Let's look at some calls. Let's go out here 53 days and look at some call options. Actually, we want to look at both, don't we? 865, 772. We could you could come in here and buy this one, and we could buy this one. That's just a nice little straddle. That's a straddle. So there's a nice little straddle in there. And you could put that on if you wanted. It's going to cost you $870 plus $762. The market would then have to move $1,600, $1,600 to break even. It'd be about right there, just to give you an idea where that market would have to move to make that thing profitable. Now, if it took off and moved really fast, it would make money sooner than that. But well, let's see if we can, about right there. It'd have to get outside that box before it hit that purple line. Do you think it's going to do that, or do you think it's going to stay inside that red box? If you think it's going to stay inside that red box and hit that purple line, you probably don't want to put this strategy on. So let me show you another strategy. Of course, this one, if we wanted to buy some shares in here, we could put let me just show you. All right. This is a learning environment. So we got to learn. I'm going to teach you how to put on a collar. What's a collar? A collar is a downside protection. Now, the reason I wanted to teach you the collar strategy was because oftentimes we're trading these index or these funds that have high dividend returns, and we don't want to sell our shares. So like right here, this is the TSLY, which is Tesla, right? But it's the dividend version of Tesla. So this version of Tesla gives you dividends, whereas TSLA gives you the growth of Tesla. So you got growth and you got dividends. And we talk about that a lot. There's lots of different pairs that you put together that can give you the growth, and you get one that gives you the dividend. And you can invest in both. But if the market starts to flush, well, you start to lose money. So how do you protect yourself to the downside? Well, you use options. And one way you can use options to protect yourself to the downside is with collars. All right. So if you own a bunch of positions in something like TSLY or TSLA or whichever one, let's go see what Tesla's doing. We sold a put here, so that's why that's drifting lower. Apple, we sold a put down here. So, and it's rallying, so we got 240 on that one. But if you have some shares, we need shares. So if we don't have any shares, you can't put a collar on. But we need to own some shares. So let's say that we own, let's come in here to TSLY. Now, the thing is, if you're going to own TSLY, for example, which is this one here that has the dividends, you're going to look and see that there are options in here, and people do trade options against this. All right. If you understand the ROCC nature of these funds, which if you don't, go back and look at last week's video series, because we talked about that in depth, ROCC, return of cash and capital. And that's what they do in here. And so that kind of suppresses and keeps the share price low. So if you want to reinvest your dividends, you can not keep getting this really high dividend price or cost to the share. So they return some of the capital, and that suppresses the growth. And that's a cool thing about this strategy. But if you don't understand that, you're like freaking out because, hey, it's going down and I should just be in the regular Tesla, which is the growth side. The regular growth side on Tesla, it goes up, but it doesn't pay any dividends. So this one pays dividends, and they also return some of your capital that you put in. And so that's how they depress the price. And so this comes in here and you're like, well, if it goes down, I want to protect my downside potential. Okay, well, let's say that let's come in here and say you have 100 shares. So we're going to buy 100 shares. There you go. So we got 100 shares of TSLY, and we're saying, all right, I got 100 shares of Tesla, and I want to protect my downside against the continuation of the downside slide. So you can come in and put on what we call a protective collar. All right. So if there's enough volume and open interest, and in this one looks like there's plenty, you're going to have to pay a little bit on the spread. But what you do is you come in to your options and you say, I'm going to sell a call up here. All right. And you're going to collect, in this case, not very much, but you only got 100 shares. 100 shares is only $13. So maybe you got more. Maybe you got 1,000 shares. So let's come in here. And we'd have to do more than that. So let's go charts as an example. Trade, we're going to do 900 shares. So let's go ahead and buy 900 shares. So now we have 1,000 shares. All right. So make it a little bit more fun. So now we have 1,000 shares. Now we're going to come in here. We got 25 days. We're going to come in here and we're going to sell a call up here. And if we're going to sell, we need to sell 10 of them. Right. So now we match. So that's $300 we're going to receive by selling this. All right. We can put it up here a little bit higher if we want. We can put a little lower. Depends on where you feel like that market's going to go. But if you think the market's going to rise, you might want to put up a little higher. But still, again, that's only $150. We'll put it right here at 300 for right now. All right. And then we're going to come in here. We're going to buy a put. We're going to buy a put at the same distance out. So the put, we're going to have to buy the put right there. $82 is, oh, wait a second. We're going to go do 10 of them. All right. So now that's apples to apples. Okay. So we're going to collect $350 on the put, or pay $350 on the put. So the put is protecting us to the downside, while the call is going to say we're going to sell out our shares to the upside. This is if you think the market's going to fall, so you want to protect yourself to the downside. But you also think, well, the market might rise, and if it does, I want to make the money between where I got in, which is right here, and the call option that I bought, which I sold, which would sell off your shares. All right, so you'd make $83 times. We got to increase that quantity. Go in here, preferences, make that 1,000. So you'd make $833 on your long position, right? And you would collect $300 on your sold call to pay for the $350 put that you're putting in here to protect yourself to the downside. All right. So if the market flushed, then you would lose money on the shares, but you would make money on the put. So that's called a collar. All right. And I was going to show you. If you put it a little closer, you're going to have to pay $825 for that, and you're only going to receive $300 on the call. If you drop that in there a little tighter, but that's not going to do you any good. You could put it right on top of it and do that, but that's not going to do you any good. You got to leave it up here. So let me show you something. You're like, this collar thing's kind of complicated, man. I don't quite understand what you're doing here. All right, well, let me show you something here. Let me come in here, and you got to practice it. You got to learn it, and then you got to practice it if you want to do it. All right, so let's come in here. And I'm going to pull up good old ChatGPT, okay? And I'm going to bring this over here. Hold on a second. There we go. There's ChatGPT, and we're going to come in here, and I'm going to show you. So you just say, what is a protective collar? And then you put in here options strategy, like that. And if you do that, it'll come right up and it'll tell you. A protective collar is an option strategy designed to limit potential losses on an underlying asset while allowing for limited gains. It is often used by investors who want to hedge against downside risk in a stock they own, especially after a significant price increase. Components of a protective collar. A long put option, which means you're going to buy a put option. When you say a long put option, it means you're going to buy a put option, which means you make money when the market goes down. I know it's a little kind of crazy, but that's what a long put is. Because you have two kinds of options. You have a call option and you have a put option. You can buy a call or you can sell a call. You can buy a put or you can sell a put. All right. So a long put option means that you're buying the put, means that when you buy a put, you make money when the market goes down. You buy a put when you want to make money when a market's going to fall. So a long put means that you are buying the put and you're going to make money when the market goes down. This acts as insurance, providing the right to sell the underlying stock at a specific price, the strike price. If the stock declines, this limits potential losses. Short call option. This is sold at a higher strike price to offset the cost of the put. However, it limits upside potential by obligating the investor to sell the stock at the call's strike price if the stock rises above it. All right. So, key features. Underlying stock ownership. This strategy assumes the investor owns the underlying stock. Risk management. It caps potential losses while giving up some potential gains. Cost. The premium received from the short call helps pay for the long put, making the strategy relatively low cost compared to buying a put alone. And how it works. Setting up the collar. Suppose you own a trading at $50. You buy a long put with a strike price of $45, protecting you if the stock falls below $45. You sell a short call with a strike price of $55, obligating you to sell the stock if it rises above $55. And I'm not going to read the rest of it, but you can see that this is how you can come in if you're not familiar with a specific strategy that I might be teaching here on YouTube or in class. You can say, well, I would like to learn a little bit more about that. Just come in and ask ChatGPT. Hey, and didn't I just very recently mention something to you about Wyckoff accumulation and distribution? Well, if you wanted a summary of what that was, you could come in here and say, hey, I am trying to learn a bit about Wyckoff. Better spell it right. Wychoff. Wyckoff. I think it's Wyckoff. Wykoff. I'm not sure how to spell it. That's all right. He'll know how. Wyckoff. I think it's CH. Wyckoff accumulation and distribution strategy. Can you give me a quick summary of that? All right. And it says Wyckoff is spelled wrong. Wyckoff. Wyckoff. I thought, okay, that's it. All right. Enter. So, the Wyckoff accumulation and distribution strategy is a market framework developed by Richard Wyckoff to identify price movement driven by institutional buying or selling, helping traders anticipate the direction of future trends. Here's a quick summary. All right. And I'm not going to read that to you because there it is for you. You can go do it yourself. And so that's the Wyckoff accumulation distribution model you can get from ChatGPT. Now, this is just a summary. You can get my take on the Wyckoff theory just by going to the book and getting the book too. But you got ChatGPT, you can use that, and that's always a good resource as well. So just a little lesson on the ChatGPT stuff that you have available to you. All right, now I'm going to show you a little trick that I like to do. Let's say that I have my Tesla in here and I have 100 shares. Now, I don't really want to have a strategy that's going to obligate me to sell my shares. Why? Because I'm getting a high dividend return on these. So, and I'm getting ROCC. So, ROCC means that they're going to give me back my money, the money that I gave them, the cash and the capital. Capital is the money I gave him. I gave him $10,000. I don't know how much 100 shares is. 100 shares in this one, positions, all chart. We gave him $13,000. Okay, so we got $13,250 in TSLY. Now, because they do a process called capital return, so they return your capital, they're going to give me back the $13,250 based on the dividends that they give me. Now, if you think about dividends, let's draw a little box here to illustrate. You guys like illustrations? Let's look at an illustration here. So the illustration is going to come in, and let's say you draw a box like that. And each month they're going to give you a dividend. And part of that dividend is going to be your own money. So we don't know how much. Depends on how much money they make. But they're going to give you part of that money. So let's come in here in preferences. That's going to be green. All right. Green, 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 green. So part of that is going to be your own money. So you gave them $13,250. They're going to give you every month a dividend. Part of that's going to be the capital or the cash that they earn, because what they're doing is they're selling covered calls on synthetic long positions. I know it's a little complicated. Let's go back to ChatGPT one more time. And we're going to bring ChatGPT back in here. We're going to go to AI tools. We're going to say ChatGPT. And we're going to come in and we're going to say, ChatGPT, what is a synthetic long options strategy? So Land talked about a synthetic long option strategy. What is that? A synthetic long option strategy is a way to replicate the payoff of owning a stock long position using options rather than buying the actual stock. This strategy combines options to achieve the same risk reward profile of direct stock purchase. Okay, and then this goes through and teaches you about how to do that. Now we're going to say, what's the next step? What is a covered call? What is a covered call options strategy? Okay, and it's going to go out and it's going to, come on, go baby, go. Go. Oh, it's still talking to us about this one. Okay, what is a covered call? A covered call is an option strategy where an investor holds a long position in a stock or ETF and sells call options against those shares. This strategy is commonly used to generate income from the options premium while potentially selling the stock at a higher price. All right, so what he's doing, what these yield max guys are doing, or TSLY in this case, he is not buying the shares himself from the money you gave him. All right, you gave him a bunch of money to trade your stock, trade with. He doesn't go and buy the shares of Tesla. He actually goes on to Tesla and he buys synthetic long positions with his options. And you're like, well, synthetic longs, that's complicated. ChatGPT just showed you what they are. Not too complicated. You can go practice them and do them yourself if you want. Okay, so they've taken your money and go buying options with it on Tesla. And they are taking the money you give them in Tesla. So this is actually not trading Tesla. It's a bucket of money that they're trading Tesla with. All right. Does that make sense? So this is not going to have a lot of NAV growth, net asset value growth. If you wanted a whole bunch of net asset value growth, well, don't put your money in Tesla because it's not going to net asset value grow. It's not designed to. All right. If you wanted a lot of net asset growth, if you wanted growth in your stock, well, just go put your money over in TSLA. That's what that one does. This one returns cash and capital. This one is actually for people who want income. All right, it's an income source. So rather than just big growth and you want income instead, they're going to give you money every month that you can live on or spend or reinvest if you want. But what they're going to do is they're going to give you back part of the money you gave them. All right. So you have, let's label these. Let's come in here with our little label thing. Part of this is going to be capital. Capital is the money you gave them. You gave them money. So they're going to give you some of your very own money back every month. And then they're also going to give you back some cash. And where are they going to get that cash from? Well, from selling covered calls against synthetic long positions on Tesla. So they're going to go over to Tesla and they're going to put on a strategy here. Now we sold a put here on this one, but they're going to put on a long position saying, which is simulated, right? Synthetic, meaning it's a fake long position. So that's what synthetic long is, a synthetic long strategy and options. And then you put that on. Now you actually have all this leverage because you're using options and you're not just buying the shares themselves. If you wanted to just buy the shares themselves and put covered calls on, you can do that. You can do that yourself. But these guys actually do synthetic longs. So they get all this leverage and then they sell covered calls. So they get the money that they receive from that. And then it's a lot more money. That's why they can give you such a high dividend over here on TSLY. So every month they've gone and they've made all this money by doing covered calls, and this goes up and down. So this money can be made, and it might lose some, but this goes up and down every month, depending on how good of traders they are, or basically it depends on how well Tesla performs, right? So this goes up and down every month. Every month you get a little bit more, a little bit less, a little bit more, a little bit less. But this one kind of stays pretty consistent. It doesn't move much. It kind of stays right in there a little bit. But they're going to give you back your own money. Why would they do that? Why would they give you back your own money? Well, there's other funds that don't, like we talked about JEPI and JEPQ, right? JEPI and JEPQ do the same thing. Where they have high dividends, but they pay it out they invest it rather than on an individual stock like Tesla. They invest it into indexes like the NASDAQ or the S&P 500. So JEPQ is the NASDAQ 100. So they're putting your money into NASDAQ 100. But in JEPQ, which is done not by YieldMax, that's done by JP Morgan Chase. So they take the money that you give them, which is JEPQ, and they put it into they actually buy shares. They buy shares of JEPQ or of the QQQ. When you put it into JEPQ, they buy shares of the QQQ, and then they sell covered calls against it. And then when they return your money every month, they only send you cash. They don't send you any capital. Okay, so that way you get both growth and you get cash. Now your cash isn't going to be as much because you're not getting any of your own capital back, but the growth is going to grow. So if you're going to do JEPQ, you want your growth to go. You want to be able to have growth, right? You're expecting not to get your capital back. You want that capital to grow and grow and grow over a long period of time. But you're not expecting to take it out, right? Don't take it out, because if you take it out, then they won't be able to sell covered calls against it and you won't be making any dividends. So, but you can later, when you get old and need some money, maybe retired, now you can start taking some of the capital out, but then you lose your cash. All right. Lose your cash income because you're taking your capital out. The cash income is going to go way down. So they're not doing cash and capital when you do JEPQ or JEPI. They're just doing cash alone and the capital is growing. So you're going to keep your capital in there. But with Tesla, they're going to actually give you your capital back. All right. And so they don't really want the NAV, the net asset value of this fund, to grow, because they expect you to reinvest, and they don't want this really high price to reinvest into. They just want you to be able to buy it back this way. So they give you your capital back as a dividend. And then this is what I call a cash cow, because eventually they're going to give you all your capital back. You give them, let's say you give them $10,000, and eventually with cash and capital combined in 1 year, they've given you back all $10,000. So now you're what I call a cash cow. You have no out-of-pocket risk. Whatever happens, happens, and everything after that is free money. I call it the gravy train. All right. So this is kind of a unique setup here with Tesla, here with what the yield max guys are doing, because they're returning your capital. They're giving you back your own money. Eventually, you're going to have back everything you gave to them with cash and capital. And from that point forward, do they still continue to give you your cash and capital? They do. They don't stop. They don't say, well, you gave us 10,000, we gave you 10,000 back. Now we're not going to send you anymore. No, they do. They keep sending you money, even though they've given you back everything you gave them. Sounds too good to be true, doesn't it? But that's how it works. All right. So that's why cash and capital is such a neat little trick. And people don't understand the differences between these things. So, you know, you're going to go out on YouTube and you're going to go watch guys that are telling you about, don't invest in yield max. They're so horrible. Their yield is going to go to zero. Their stock doesn't go up. You get no NAV. You're going to die. Bad. They just don't understand. They don't understand the concept of cash and capital return. They don't understand the ROCC versus ROC. All right. So ROC is what most companies do. They take your money, they throw it into a stock, they sell covered calls against it, and they give you the cash. And then you want the growth. You want that thing to continue to grow, and they'll just trade the covered calls for you and send you the cash. So people get confused. They don't realize that YieldMax has a different model, and they're going to actually return your capital too. That's why the dividends are so high, is because it's just returning your own capital, which is nice, right? I mean, hey, who wants zero risk after they return all of your capital back to you? You still get money. That's pretty cool. And it's done on an individual stock rather than on an index, because an index moves very slow, whereas an individual stock can move very explosive. You want to be careful because it's going to move a lot, and it's going to scare you, because you're going to be looking at your report and it's going to say, oh man, I'm down $3,000. Oh man, I'm up $3,000. Oh no, now I'm down $3,000. I'm up $3,000. Doesn't matter. It's irrelevant, right? Because they're going to take some of that and they're going to give it back to you anyway. So that's cash and capital. Now, for those of you who are not aware, I have a magazine, if I can find it here. I have a magazine called Pit News Magazine for the club. This is our club magazine, all right? And let me get out of the way here. And in Pit News Magazine, the reason I bring this up right now is because in Pit News Magazine, this whole issue for February is going to explain this whole yield max thing. The whole issue is all about different component pieces of trading cash ROCC, return of cash and capital. All right. So that's the whole magazine. And you can get the whole magazine, not only the whole magazine is almost like a $200 course. If you want to go buy a course on ROCC and how this all works, well, there isn't any for one. About the only one that I know of that's teaching it properly. So everybody else is teaching it as if it's ROC, and they don't understand it. And they're like, these things suck. Don't invest in them. It's because they don't understand what ROCC is. It's a relatively new thing that's going on with what these guys do. And so most people aren't teaching it. And so I wrote up in Pit News Magazine my article, and then I had a bunch of guys help me write other articles that kind of correspond to what's going on here. And it's in Pit News Magazine, this month's issue. And to get that, you can go subscribe to the magazine. It's only $19.97 right now. It's regularly $39.95 a year, but it's on sale right now for $19.97 for an entire year for 12 issues of the magazine. But that one issue, this issue that's coming out in February, I could sell what's in there for, a lot of money, because it's really a good issue of the magazine. That's a whole course on how to do this ROCC stuff. And we'll continue. We're going to do in the next issue in March, we're going to talk about just continuing on how to trade all these things. We're going to teach you all about the option strategies that you can use. We're going to talk about hedging this stuff if you want to hedge it, how to hedge it. And that's what I want to talk a little bit about today. And then, of course, we're going to talk about how to do it yourself. I mean, if you wanted to reproduce this model in your own portfolio, and because if you'd reproduce this model in your own portfolio, you might be able to make a lot more money than what you get just by giving your money to them and letting them do it. But we like to go and collect money in our portfolio, right? We like to trade our money for cash that we can then put into the high dividend returns. And it's just kind of a way to get money to put in there. You got to have money to make money. And if you don't have any money to put into these ROCC funds, you got to go get money. And how are you going to do that? You got to have a job. Go pump gas at a gas station. Go run Uber. Go drill teeth. as a dentist. You do something to get money so you can put it in there so that you can get these returns. The way I like to do is trade the stock market, go sell options, go collect, get some premium over there, and then collect that premium, bring it over here and put it in here and let these guys trade it. So there's different ways you can make money. But another thing you can do is you can hedge your position. And if you're going to hedge your position, let's say you got one second, I got to drink some tea. So if you're going to hedge your position, let's say you got 1,000 shares over here in TSLY and you don't want to sell them. So you don't want to put a covered call on here because it might call them away and then you'd lose your position. If you lose your position, then you miss out on your high dividend return, which is what you really want, right? You're kind of waiting for your high dividend return. So trading options on this one is not as wise. Not that you can't do it. You certainly can. You can come in here, and the simpler way would just be to come in and buy a put, right? But you have to pay for it. So you can come in here and we just buy a put. Let's come in just to the puts. And this would be a way of protecting your downside. You come down and say, well, I think it's going to slide down. I want to protect that. You just come in here and you go into your options and you buy a put. So buy a put. And that would just drop it in there. It's going to cost you $80, but we're going to do 10 of them. And that would be a what we call a perfect hedge. And that's going to cost you $800. Well, how much are you going to get on this? You'd have to do the math and calculate it out and see if the insurance policy is worth it, right? Because you're going to get a big dividend return, which is going to be partially part of your own capital. So they're going to give you back this big dividend. Are you going to use some of that dividend to protect your downside in case of a continuation of the slide? You can do that. That would be a perfect hedge right there. If the market fell at all, you'd make as much money on the downside as it's losing on the upside with a put like that, because you're covering it at 100%. Well, it's a delta 0.50 right now, but at expiration, it would be a delta 50. So you can determine you don't need full coverage, right? Just like on your truck, you drive your truck around, you have to ask yourself, do I need full coverage? No, I don't need full coverage. I'm pretty confident that, I'm not going to wreck. So, but if you think you're going to wreck, you want full coverage. But if you think you want to protect it just in case it wrecks and you're not sure, you don't have to buy full coverage. You could come in here and drop some of these down. You go all the way down. There's what we call a hedge. The other one was called a perfect hedge, right? So a hedge is just half. You're only protecting half of it. And you're letting the other half ride without insurance. But that gives you some confidence to say, well, I don't necessarily think it's going to fall, but it might. So I'm going to put on a hedge. And then in this case, it's going to cost you $400. And that's going to protect you to the downside for the next 30 days, 25 days. And then if you want a perfect hedge, you're like, oh man, that thing just broke the blue lights and it's headed down. And the green's down here, everything's going down. I'm not happy. So you're going to go in there and put on a whole full hedge. But you don't want to take off your position, because if you take off your position, you miss out on the dividends, right? So you put on a hedge, and it's going to cost you $825 of the whatever 1,000. How many? Let's go figure it out just for fun. How much are they going to give us? Because this is going to cost us $825. It's a good exercise, so you can figure it out. So $825, and we're going to protect our Tesla position to the downside. Let's go see how much they're going to give us in dividends to see whether we want to do that or not. So the way we do that is we come over here and we say, how many shares do we have? Let's go back to our positions. And we have 13,250, but we have 1,000 shares. So we have 1,000 shares. So we're going to come over here to FinViz. Boom, 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 boom. And we're going to go in and we're going to pull up TSLY. And in here, we're going to come in and say, well, last time they paid out at 71 cents for shares. So if I take 71 cents and I have 1,000 shares, so I'm going to get 70.71 times 1,000. Well, we all can see how much that is, right? 0.71 times 1,000 is $710. So they're going to give you $710 in dividends. And if you buy a perfect hedge, it's going to cost you $825. So that's not worth it. So you better just do a half hedge. There you go. So now it's $400. So you can spend $400 of your dividends to protect your downside, to hang on to your dividends so you can make the $400, but it's only going to protect you halfway. You just have to decide if that's what you want to do. You can also do your hedge over here. Now, this is what I like to do. You can hedge in here if you want to in TSLY, The options, they're doing okay. I can't complain. And then if we come over here to trade and you go into options, you go to chart, and you go into Tesla, this is where you want to hedge, actually. This would be better off to just buy your hedge over here. So what we'd do is we'd come in here and we go options, and we're going to hedge over here, say 25, and we'd buy a put. And you drop your put in here. Now, this is going to be a lot more expensive. It's $2,625 for quantity one, but it's going to be a lot more sensitive to the drop in the market. So you're going to make more money if the market actually does fall, and you're going to lose less money probably if the market rises a little bit. It's all a percent difference. If it does start to rise, you want to get out of this thing because you could lose the full 2,675. That's not going to help you on your hedge, but you're going to make a lot more money if the market actually does fall over here, and it's going to cover your hedge a lot better. Okay, not that you can't do your hedge over in TSLY. You certainly can. You just saw the example of how we could do that. But you can determine how much you want to hedge, and that's the whole idea. So you can do it in both places. You can do it on Tesla, or you can do it on Tesla, and you're going to hedge one or the other. All right, and that's going to protect you to the downside. Now I got a little story to tell you. The guy who started this company called YieldMax. His last name is Petrocelli. Can't remember his first name. His book's out in the front room. So he tells a story where I'm going to tell you the story real quick. Oh, you know what? Doggone it. You just went and missed the whole. I hate it when I do that. Doggone it. How am I going to go and do you? Am I going to do that all over again? Okay, just in summary, you can hedge by buying your put options on either the TSLY where your shares are, or you can hedge by going over to TSLA and hedging over here by buying a put option to protect you to the downside on Tesla. And that's what I was showing you. I was just putting the options on. Doggone it, I hate it when I leave that stupid slide up and you can't see the chart and I switch over. I make that mistake all the time, and I got to figure out how not to do that. I got to stop using this stupid slide projector over here. That's why I have the slides here. No, here, so that I don't do that, and I did it anyway. Yeah, this is what I got to do. I got to do it here. This way it covers up the charts, and I can't get to the charts and go back and do that. I can't make that mistake. I got to just stop doing that. All right, let's get rid of it right now. Delete, remove from studio. Okay, it's gone. I can't do that anymore. I apologize. The whole point of that was that you can hedge on Tesla, not just on Tesla. All right. Even though your shares are in Tesla, TSLY, you can hedge your position by putting your options on TSLA. All right. So that was the mathematical model that we put together. Ah, shucks. I feel bad. All right. Let's move on. So the point that I was making is this guy who put these things on here taught this. He used to work for Ameritrade. How many of you remember back in the good old days when it was TD Waterhouse? Does that name ring a bell to anybody? TD Waterhouse? Remember TD Waterhouse? They were a big firm, and they merged with Ameritrade. Okay, so there are two companies, TD Waterhouse and Ameritrade, and they merged and made TD Ameritrade. That's how you got TD Ameritrade. They become like this giant Walmart of brokerage firms. If you know, that's what they are. They're like Walmart of brokerage firms. So he used to work for Ameritrade before they merged into TD Ameritrade. He used to work in Ameritrade. So that's how long ago this was. He's been doing this a long time. He's been trading options for a long time. Very smart guy, obviously. And been immersed in the world of finance his whole life. And the whole idea here is that they were in Ameritrade and they wanted to find out why people lost and made money. And so they had access to everybody in Ameritrade, which was a big company, right? That's why it merged with TD Ameritrade, TD Waterhouse. So they were a great, big, huge firm. And they had that. What they discovered is, I'd draw you another illustration and another diagram. What they discovered How come that won't let me scale? What's wrong? Huh, that's weird. So they they discovered that there was a group of people who made money, about 25% of their clients, and there was about 25% of their clients who lost money. All right. So we'll make that one red. This is my. And then there was about the other 50% who, didn't make money or lose money. They just kind of did nothing. So their money never really made any money, but they never really lost any money. And that's a bigger group. So we'll make this like this. But there was a group that made money and there was a group that lost money. And then there's the neutral group who never made or lost money. So this group, they took the top 25 profit makers and compared them against the bottom 25 losers. And they wanted to find out what the difference was. And they did all kinds of tests. They're like, okay, maybe it's a class thing. Maybe people who have bigger accounts make money and people who have smaller accounts lose money. But that wasn't true. What they found is that was basically an equal distribution. Just as many people who had big accounts lost money as made money, or people who just as big accounts who made money lost money. Small accounts lost money, made money. So they looked at other things. They're like, okay, well, maybe it's race. All right. They tested race. Maybe white people make all the money, black people lose all the money. Right? Maybe the other way around. Maybe black people make all the money, maybe white people lose all the money. So they checked this and nope, made no difference. Didn't matter whether you were black or white. Didn't matter if you were brown or yellow. Didn't matter. Race had nothing to do with it. You had just as many people who were black, white, yellow, red, pink, purple who made money as black, white, pink, purple, yellow lost money. Equal distribution across the board. So they're like, well, what else could it be? And so they tested all kinds of things. All right. They tested everything they could. And finally, it came down to, well, maybe it's their strategy, right? Maybe it's their strategy. Maybe the strategy they use. What strategies are the winners doing? What strategies are the losers doing? They went and looked and they're like, there's no difference. Again, it was an equal distribution. Strategy didn't make any difference for the winners. Same for the losers. The losers use the same strategies or indicators or tools. It's like the same number of losers. They use MACD just like the guys who are not using MACD. They make money, they lose money. What's the difference here? They cannot figure out why 25% of the people made money, 25% of the people lost money, and the other 50% of the people just did nothing. They went straight neutral. And they looked and looked and looked and looked and looked and looked. And they tested everything they could imagine to try and figure out what the difference was. And the only thing they found that was the difference, you know what the difference was that caused people to make money versus people who lose money? The people who made money hedged their positions. That was the only difference. It was the only difference they found. People who made money used stop orders and hedging strategies that would protect their downside. If the market would start to go down, they would either get out of the market, right? How many times have we told you that? Don't stay in a market if it's going against you, right? Use stop orders, get out of the market. The only difference in their entire company that they could find out of all the demographics of all the things they looked at, all the strategies they looked at, the only difference between the winners and the losers and the neutral people, they would sometimes do it, not sometimes do it, right? They were wishy-washy about whether they used stops or not. The only difference was the people who made money were people who hedged their downside risk, whether it was with a stop order to just get out when the market falls and wait for it to go buy low and wait for it to go back up, get out when the people who just at the very bottom, they would just never get out. They would hang on to everything. They'd hang on, I'm going to buy and hold, right? So they would buy and they would hold and they lost money. Or they would get out when they're scared, or they'd buy at the top, they'd sell at the bottom. They never used any hedging strategies. The people who made money, the only difference between people who win and lose were people who hedged, meaning that they would get out if they were wrong, or they would protect their downside using options to protect their downside when the market went down. That was the only difference between them. How hard do we press that in this class? We talk about that endlessly. Stop orders are the most important things you can use. You got to get out of the market if you're wrong, right? Admit that you're wrong, get out. Don't hang on to it and think that I'll wait for it to come back. because if you do that, you're going to be part of this group down here. That's this group. I'm going to not get out. I'm just going to wait for it to come back. All right. This group, they get out. And then when it gets down to the bottom, they get back in. This is the accumulation distribution model group. The Wyckoff accumulation distribution model group. This is the buy and hold group. And this is the group that just kind of tried to do a little bit of everything, but they never really lost money. They never really made any money. So they would try to do a little hedging once in a while, but most of the time they didn't, because they didn't know if that worked or whether they should just hold on or the buy and hold. They just were wishy-washy people. But these people were very systematic. They'd get out if the market started to fall, and they would get back in when it got to the bottom, started to rise. This one here, these people would just hang on, and ride through the bull, right? That's what their study found. So I just kind of wanted to bring that to your attention. I thought that was very interesting. As I was reading his book, he put that information in there. And we kind of all know that, right? You got to get out if you're wrong, and you got to get out and not let the market take all your money away. So the point is, circle back around to what we're doing here. If you're going to be over in the markets that are like TSLY, and that's why I mentioned, these, we generally just hang on to them. And the reason is because they're returning cash and capital. And they're kind of controlling the cost or the value of that share. They're going to kind of keep it in a channel, or it's going to actually drift a little bit lower all the time because they're giving you back your capital. If you want to hedge this, you can, because it freaks people out to see their value of their share price going down all the time. And that's just what it does, because it's not really going down. It's because they're giving it back to you. All right. So if they give you back the value of the shares, it's going to drive this down. So they take the cash and the capital every month, and they give it back to you. This thing's not going to really ever have a big net asset value run, because if it did, it would just be Tesla. It would just be this fund. And that's not what they're trying to do. If you wanted that, just come here. There's already one of those. This one here is not going to have a big net asset value. You can protect to the downside if you want to. It's just an additional way of trying to make money, but they're going to give you back your cash and your capital on these yield max funds. All right. So I just wanted to bring that to your attention and let you think about how you want to handle that, because this is kind of designed to be a buy and hold, and you can hedge it if you want to, but it's not really the point of this fund. So when you talk about this model here of being, the winners, the losers, and the winners always, being because they would get out of the market if it would flush, I hesitate to tell you that on this one, because that's what they're doing for you already. This is not really a fund that they're trading your money. You're just giving them your money. Think about it like a business. Let's say that I want to start a business, and I'm like, hey, give me, each one of you give me $10,000 to start my business. What's the first question you're going to ask me if you give me $10,000? How long is it going to take to get my $10,000 back, right? That's the first question you should ask if you go into a venture capital business. You can say, okay, I'm going to give you $10,000. How long is it going to take me to get my $10,000 back? And the reason I'm giving you the $10,000 is because now I'm part ownership in your business. You're going to give me some of the profits from then on, right? So that's what this is. You're actually going into business with YieldMax. They're going to trade your money for you. You give them your money. They're going to give you back your $10,000 and some of the profit. Eventually, they're going to give you all this back. Now all you get is profit. All right, cash. There's no more capital coming back. Now capital's all back. They give you your 10,000 back. Now all you got is just cash coming back to you. And how long are they going to do that? Well, as long as Tesla stays in business, they can keep trading against Tesla, because that's what they're doing. They're trading against Tesla. You give them 10,000, they're going to trade you 10,000. They're going to give you back 10,000 plus cash along the way. And then once they give you your 10,000 back, you're on the gravy train. So that's the name of the game over here with this YieldMax stuff. And you got to keep that in mind. Now, do you want to hedge it? You can if you want, but it's going to go up and down. It's going to go up and down based on what Tesla does, and they're going to just keep returning you your cash and capital. You can hedge it if you want to, because this will probably continually slowly go down, because they're just going to keep pulling cash and capital out. But as long as people keep putting money in there, they can keep trading it. They'll keep returning their cash and capital, make money, and they can kind of control this, right? They can kind of control it by how much do they want to give back in capital or in cash. If they need this market to go up, they just return to you less capital or less cash. And then they could return less capital too. So if they have a bad month, they can give you less capital and less cash. And then this will stabilize and it'll allow it to turn and start to go back up again. But if they have a good month, they're going to return to you a lot more money. And then this is not going to go up because they're giving it back to you. That's how it works. Okay. All right, guys, let's go back over to our portfolio here. Let's swing back over and take a look at some of these stocks. So we're making money on this one. We put one on. We wanted to put two, but we only put one because we thought it might come down a little more. Now that it's popped up, makes you wish you had two. You put one on right now, you're not going to get a lot of money because it's in a big. We're going to sell one here, 25 days. Well, we'll get $655. Last time we got $950. $650 is not bad. I mean, we could put that on. We come in here and sell that. That's right. Oh, that's right at the money. So see the difference? 365 versus 950. And that's even in look at that. That's the difference. 950 versus 297. Selling your put on a rally bar is the difference between selling your put on a down bar. So the down bar, we got $950 last week. Today we sell that same put, we only get $300. That's the difference between buying it on the way down, catching a falling knife. We all hate to catch a falling knife, but we do that because when you're selling options, you have your target locations because you get the 950 as opposed to the 300. So now you only get $300. What's the point? We'll wait and see if we can get a down day, and then we'll do it again. Let's get a much higher dollar amount. Let's go and see if Amazon. We took all of our profits off last week. Ooh, Amazon flushed hard, but then it came right back to the open. We're in another Darvas box here. This Darvas box went kind of, I'd say right here. Let's take this Darvas box from here to here. And then take that and put it up here like that. That's really weird. Don't let me take it off the screen. I guess that's okay. All right. So that's the new Darvas box. And so we start a new, so this is drive 1, drive 2. Look, that drive 3, that's why we had the Darvas box out there, because the drive 3 broke this previous high and went up into the next Darvas box. So that's drive 3, drive 1, drive 2, drive 3. We got the reset here with the red bars. Technically speaking, we should have got that little ABC top formation up here. A, B, well, kind of did right here. A, B, C. Boy, it was tiny. It went red. This is our first little ABC, A, B, C. And it came down, up and down. That's kind of getting messy in there. Oh, what happened? That's not what I wanted to do. Delete. 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 Too many. Too many. Oh, now I deleted the wrong damn thing. Stupid piece of shit. Come on. All right, so that's our box. And that is, I guess it's a one drive down. It's got some fractal drives in there. But it did reset all the way to red. And now it's breaking the previous high in here. That's Amazon. And Amazon didn't flush like all the other markets. When it came down, that's a tiny flush in comparison to all the other markets. This is a strong market. They're doing well. Let's go over and look at the Amazon. We want to go look at Amazon. I think we looked at this before, but it never hurts to look at it again. Earnings per share, 290. Earnings per share currently sitting here. The PE ratio. $394. That's better than 290. Sales in billions. Their sales are at 620. Right now it's 574. So their sales are way up. Shares, they're not buying back their shares. See, they got really good fundamentals. Really good fundamentals. Don't want to be short in this market. But it does have, wow. When was the last time it came back to the red zone? Clear back here. I don't know. We could probably, let's see what an option would be to sell back there. We do sell a put back in here. You're only going to make $100. 295. 580. See, we want to wait for it to pull back, but in the meantime, I mean, if it rallies, where do you want to buy some shares? You want to buy some shares right there? As it breaks above the previous high? Could. If it breaks higher and keeps going, that's $900 that you'd make right there. We think Amazon's going to keep going higher? If not, you don't want to do this. You don't want to sell it at $900. This is buying on a break above a previous high. It flushed today and now it rallied back up. If we think that thing's going to continue higher, we could sell that and make $900. And then the worst case scenario is we'd have to buy 100 shares of Amazon at that price. And it might be down here. And that would be the drawdown. But it's all the way at the top of the 3 drive. It's just scary to buy right there. But if that thing's going to continue higher up through that Darvis box, that could be a good buy. Make $1,000. We can always get out if we're wrong. Okay, we just made $1,000 on that one, but we have to wait for them to give it to us for the next 25 days. This is Bido. Bido is the Bitcoin, and it doesn't look favorable right now, does it? Bitcoin looks like it's going to fall back down, and it has been falling down. I've got some Bitcoin, and it's been flushing back down. It rallied up good. It got up to like $107,000. Now it's back down to below 100. What is Bitcoin today? Let's look and see real quick. Bitcoin is currently sitting at 101. Oh, so it went back up. It was as low as $97,000 for one Bitcoin this morning, and now it's 101. So it went up $4,000 per Bitcoin this morning, just today. So that little flush right there on Bido. What do we think that's going to do? Do we think it's going to turn and keep going? A little bit of a pullback. We could buy some more Bitcoin down here at 38.2. Let's come in here and go options. Go into 25. Let's sell a call, sell a put right here. That's only $137. That's because it's $24. There's no volume. There's no open interest. We don't want to do that anyway. That one's not bad right there. It's $110. $110. We could put in $500 worth, receive 500. That means you'd have to buy 500 shares. So 500 shares times, what's the strike? 23. That'd be $11,000 investment if we had to buy the shares. That wouldn't be bad. We could go ahead and do that. Let's do that. No, it's not going to let us do it. Volume's pretty low. 1,800. So, well, that's above 100. That's not bad. How come it's not letting us do it? The spread is $8. You guys can't see that again. Let's see. Put you over here. So if we wanted to do that Bido, we could sell a Bido. $106. Get in there. Okay, we got that one. $500. What about Google? We'll wait on Google. Mags. Don't really want to do that one. Meta. Oh my goodness, look at Meta. Wow, break above a previous high and away it went. Doc Brown's happy. I know he's got a bunch of Meta long calls. Microsoft. Oh, Microsoft had a big flush today. Let's see what the options are. Oh, that would be. Let's come in here and sell a put down here. This is $600. Right at this area of support down here, right at that blue light. $700. I think that would be a good deal. We wouldn't mind having some shares right there. That's 665. Let's go ahead and should we just do one of those? 660. Okay, so we take that one. MSTR, another one that we wouldn't mind owning. This is Bitcoin again. I'd rather wait for it to come to me a little bit closer, but it might not come down there. Got a nice little area of support right there. If it breaks that, that'd be a big flush for MSTR. If it comes up, breaks down, if it breaks that blue light, it could turn and hold and have that little double bottom in there. But the next layer is this 200 period moving average down here, which if we project that out, we're talking about coming in down in this region here. That's nasty. That'd be a nasty drop. That means Bitcoin would have to drop quite significantly. But that's what those numbers, that model is telling us. In the meantime, you want to try and make some money off of it? You can if you want. Come in here and we go options, 25 days. Going to sell a put. We'll just sell that put right down here at the low. That's $832. Wouldn't be a bad place to own some shares. $28,000. Let's see. That's quite a. That's $55 in. Well, the spread is 0.2%. That's not bad. 3,000. What are we? Wait a second. We're only picking up. Oh, that's not the one we're buying. Way down here, $35. 0.4. Look at the volume on that. It's not as good. If we can go here. 25, but then we only make 7. So we get a better spread, but we give it up in premium. If we go up, we get a better spread. No, we don't get a worse spread. We go from 30 to 35, but then we make an additional $100. But then you're a little closer to the market. I think that's the better deal right there. Let's do that one. So we're going to go to 935. Receive $935. Okay. All right. So we got that one. If that market keeps coming down, I have to go through a little drawdown on that one, but we'll see. Misty is another one. That's the MSTR. This is the ROCC version of MSTR. So it just crossed. It's a little shelf right there. That's not good. That means that this market's probably going to go down. But that's a nice little hedge right there. We pick up $1,000 over here as this market comes down. And then if we wanted to buy, we wouldn't buy here. We'd buy over here. Do a little sneaky trick. All right. So NVIDIA, Misty. Yeah, that's not good for Misty. Misty's flushing. NVIDIA. Oh my gosh, look at NVIDIA. Holy cow. Did they have an earnings today or something? Their earnings are November 20th. One. I don't think that's an earnings. It's not long enough. Huh. Deep Seek makes NVIDIA investors face 8 secrets of selling. Down for it. Stock market today. Dow Jones dips as NVIDIA plunges on China AI move. Microsoft Alphabet skid. Did China's Deep Seek just burst the enterprise AI bubble? Why NVIDIA's stock is plummeting today. Investopedia. Why NVIDIA is plummeting. Shares of NVIDIA tumbled Monday after the release of a sophisticated artificial intelligence model from China prompted a reckoning on Wall Street regarding AI spending. Chinese company DeepSeek last week released R1, an AI model that appears to rival the capabilities of models from U.S. tech giants like OpenAI and Google, despite running on fewer, less powerful chips. U.S. investors began to take notice of the model last week and over the weekend starting to worry about what it means for richly valued U.S. tech stocks. NVIDIA's earnings and stocks price have soared in the past years. Giants like Microsoft, Alphabet, and Amazon have spent massively on AI systems. DeepSeek has led investors to queue whether all the spending was necessary and, if not, why it would continue. NVIDIA's stock was hammered by Monday's sell-off. Shares tumbled more than 13% in recent trading as largely an intraday drop since tech rout in August as its deepest Monday sell-off wipes nearly $480 billion from NVIDIA's market cap. Wow, what analysts were saying. We're mostly skeptical about DeepSeek and the sell-off prompted, though their community often reflects uncertainty about the effects of DeepSeek. That's crazy. That thing came out. That Chinese model came out last week. This is called the R1 model. It's been, I don't know why they suddenly got scared to this week. That's weird. Huh. You get $640 selling a put there. But if that market continued to flush, that would be a nasty. I think that's a knee-jerk reaction. Palantir. Palantir flushed today too. I think Palantir is a great company, and they have big government contracts. And I think it would be nice to see them pull back a little bit to give us the opportunity to get in down in here again. But I don't want to. I want to wait for them to come down there before I actually sell the shares, sell the premium. Because if you sell the premium today, it's not very good. Sell a put down here, $188. If you wait, it would be more like $700. You get the $213, but you sacrifice the other 500. Just wait for it to come to you. So we'll wait for that one to come to us. Tesla. That's a C1 fail. So drive 1, drive 2. It hasn't quite failed yet. I mean, it's got to break that blue light before it fails. So I put in there C1 failed because it hasn't. It's pulling back off of that blue light break, but it hasn't technically failed yet. It doesn't fail till it breaks the blue light. And then TSLY. We have 1,000 shares of that one. All right. I think that's all I got for you today. I apologize for screwing up and leaving the slide up for a little while. Let's come see what people are saying. Say, there's John C. saying hello. Good morning, John. It's great to have you. Kirk's great to see you. Frosty, great to have you. Jay, it's great to see you guys all in here. So glad to have you. Kirk, nice to see you guys all come and hang out with me a little bit this morning. We got a lot more people watching than what says saying hi. So if you guys want to put your names in there and say hello. But we're sitting a little bit upside down, it looks like, on some of our positions right now, but I'm not too worried. We'll see. I think the market's just having a knee-jerk reaction against that Chinese AI firm releasing their we'll see. It could be a disruptor. Who knows? And we might take a little loss on it. We'll see. All right, guys, that's what I got for you. I got a Sunday school lesson. Let's end with a Sunday school lesson. Don't buy into hyperextended overbought markets. All right. This is a hyperextended overbought market. We oftentimes feel FOMO on these. Fear of missing out causes us to make unwise decisions to go and buy into these really high markets. So notice we try to avoid that. So usually when you see a market like that, it flushes and turns and comes right back down for a long period of time. And that leads us back to what we were talking about earlier about using hedges and using stop orders. If you're wrong, just admit it and get out. All right. So we're going to have downside trades. Markets don't always go straight up. They go down. And sometimes they go down for a long period of time. They can go down for 3, 4, 6 months in a row. Look, this is Tesla right here. Tesla went down 1, 2, 3, 4. That's 4 months. 4 months downside potential. And if you're just buying and holding, that's a long time to buy and hold. Tesla here, right in here. That's where that was. That was Tesla. So that was the giving your money back. That was your ROCC one. This one here is the Tesla. So markets don't always go up. And that's why those guys did those tests and hedge yourself. And if you don't want to hedge by getting out, because you're like, oh, I don't want to get out, well, at least use an option to protect yourself to the downside. And it doesn't have to be a perfect hedge. You can just do a partial hedge. And you can get a little bit better returns by hedging your positions, and you can use options to do that. All right, guys, tonight is class. First night of class at the university. Those of you who are able to make it, it'd be great to see you down at the university tonight in person. And it's going to be an introductory course into the stock market, getting people started with all this fun stuff that we do here that we get pretty in depth today. We got pretty deep with talking about synthetic long positions and stuff. That's pretty advanced stuff. But if you understand that, then, hey, you're coming along well. You're getting advanced in your understanding of the stock market. So let's jump around, see what we're doing, and see you down here tonight. And if you had fun, click that little thumbs up. Today was a little disjointed because of the slides that I left up, but hopefully you guys got something out of it. We learned something, and maybe we can make a little bit of money on some of these sold puts that we made so we can put it over into our ROCC, right? All right, guys, take care. We'll see you. We will see. We didn't close out any positions today. Nope. So we don't have to go over to the spreadsheet and enter anything. Nothing there. All right. We will see you next time. See ya.